Greetings, everybody, and a warm welcome to all of you. Welcome to another webinar with SPJIMR, Bhavan's SPJIMR's Center for Financial Studies. This one, as you know, is entitled The Quest for Financial Stability in India. And it's my privilege to welcome Dr. Viral Acharya, the CV Starr Professor of Finance from NYU-Stern. Total privilege to have you, Dr. Viral, and look forward to an enriching chat. It's also my pleasure and privilege to welcome Dr. Ranjan Banerjee, our Dean of SPJIMR, and Neeraj Swaroop, the head of the Center for Financial Studies. So without further ado, I'm going to first invite our Dean, Dr. Ranjan Banerjee of SPJIMR, to first give us a few opening comments. We'll follow that with comments from Neeraj. We'll then get into the Q&A with Viral Acharya. Dr. Ranjan Banerjee, all yours.
So good evening, and thanks Ananth for that introduction and the preamble. I think it is a pleasure for me to be here and to introduce this particular webinar. I will speak more from the institute perspective, and at SPJIMR we have a mission statement that says our mission is to influence practice and promote value-based growth. And I'd just like to talk briefly about what I think influencing practice means, and if possible, link it to what I understand about the profile of our speaker today. So to me, to influence practice, for an academic institute to influence practice, there are 3 or 4 things you need to do. You cannot influence practice if you do not first understand practice. And in order to understand practice, practitioners and academics must engage with each other. So there must be conversations where we are talking to practitioners, engaging with practitioners, and hopefully the research that we do is driven by issues that practitioners will care about in the next 10 years. So the first aspect is engage, the second aspect is research. And then when we have done research on issues that are of relevance and importance to practice, we take them back to practice. And we engage again with how that research can be applied. Now, specifically in the financial sector, if you look at 3 broad divisions, and we call it academia, we call it practice, which is largely the institutions in the financial sector, and the policymakers. Then these are the 3 dimensions across which one needs to influence practice. And I think the first thing that is remarkable about our speaker today is that it is only the exceptional academics who have not just tried to venture across, but have bridged these gaps. And to me, bridging these gaps means that if an academic spends some time in policy, spends some time in practice, and then comes back to academia, then that does a lot to bridge these gaps, and that does a lot also to ensure that the thinking that we are bringing to the table is current. So I think Dr. Viral Acharya exemplifies some aspects of that. So I think that is one thing. The second is that as an institute, we talk about a slogan that says courage and heart. And I will talk briefly about both these words. And again, so to me, courage is the courage of convictions that says that as a practicing intellectual, if you have an informed point of view about the world, it is your responsibility to bring it to people, irrespective of whether that opinion is completely politically correct or not. Because more than ever, people of intellect and people of objectivity must bring their opinions to the world, because we see this courage as something that is lacking. And secondly, Viral, I was doing some research and I was looking at your involvement with Pratham. And I think at the institute, we are very big. I don't know if you're aware of this, but our students, before they do corporate internships, they do 6-week internships in the social sector. All our students mentor children from the nearby slums, nearby underprivileged areas, and they actually go to these areas and spend time with those children. So I think the fact that you are so invested in improving the quality of education in India, because I think one of the things that we strongly believe is that we have built an unfair country. I mean, anybody who is on this panel, all 4 of us, we are here because we went to the right schools and we were born in the right families. So you cannot talk about equality of opportunity unless you can talk about equality of access to education. And I think it is good that we are thinking about this and doing this. And lastly, I must conclude on a slightly jingoistic note that, Neeraj, I'm sorry, you're the odd man out. 4 people on the panel, 3 are from IIT Bombay. So you are holding the flag of IIT Delhi. And with that, I will hand over to Neeraj. I think the Center for Financial Service Studies, this is the kind of thing that we are talking about, where we can get leading academics and thinkers across the world and engage on issues that matter And it is through engagement that we start to influence practice. It's through discussion and debate that we start to influence practice. Thank you, Neeraj, all yours.
Thank you, Ranjan. Let me begin by joining Ranjan in welcoming you, Dr. Viral Acharya, to this talk, this webinar today here. I wanted to take this opportunity to talk a few minutes about CFS, the Center for Financial Studies. Ranjan talked about the fact that one of the missions of SPJIMR Institute of Management and Research is to influence practice. And being in Bombay, the financial center for India, it was the vision of the institute to set up a center which would be and is therefore a platform for collaboration and interaction between policymakers, academic professionals, academicians, and working professionals in the area of finance to collaborate. And we look to three kinds of activities out of the center. One is work in terms of research with industry to see what we can do in the area of practice. Two is executive education, again for the working professional. And three, webinars and seminars and platforms for debate and discussion. And in that light, we've been holding a series of webinars over the period. We launched the center last year in October, and since then we've been active, more visible through these webinars and talks. Also, the center focuses on 5 broad themes, which is to do with regulation and policy. It is to do with accounting, fintech, financial inclusion, and governance and risk. I've also want to take this opportunity to announce a new initiative that the center would be taking, and this is for the wider audience, to set up a policy forum, a CFS policy forum, where we want to bring policymakers, the other participants from the industry, including corporations, market makers, and academicians to be able to debate and suggest policy formulations and at least debate what could be in the interest of the industry. So we hope that will more of that will happen, and people who are attending today's webinars would hear more about this in the time to come. Anyway, that's all I wanted to say about CFS. Today we are gathered here to hear Professor Ananth Narayan in conversation with Dr. Viral Acharya, who is the CV Starr Professor of Economics at NYU-Stern School of Business. He is a man who needs no introduction, really. I mean, in the sense, his CV is in the public domain. He's been a brilliant academic, a gold medalist from IIT Bombay, and followed up with his PhD in from the NYU-Stern. If I remember, his thesis topic was essays in banking and financial institutions. He's worked at LBS. He's worked at, of course, at NYU-Stern after that, which is where he is today, but he was before he did his term with the RBI as Deputy Governor from 2016 to 2019. He is a multifaceted personality, many interests. Ranjan mentioned Pratham, music. He's received many awards, and I won't go into those details. All I'll say is that we're honored to have him here with us today. I congratulate you, Dr. Acharya, on your new book, and I look forward to hearing your thoughts about the quest for financial stability in India. Thank you. Ananth.
Thanks a lot, Ranjan and Neeraj. Really appreciate those opening statements. And once again, my personal thanks to you, Viral, for being here. The way we'll do this is the following. We already have some crowdsourced questions, which I'm going to rattle off and throw at you. They fall broadly into three buckets as far as I can see. A few of them are personal questions where we'll try and figure out more about Viral Acharya, the person. Second is about your book itself, some issues there. And the third is more about questions about the way forward, the way you see things panning out from here. We'll also leave about 20 minutes for audience questions, and we'll try and collate them as they come along. We already have a healthy audience which is built up right now. We'll finish by 8 p.m. IST, and that's the broad plan. So let's start right away, Viral. First question that I'd like to present to you is, you've dedicated this book to your teacher, Shailesh Shah. Tell us a bit about him. What is it about him that inspired you so much to dedicate this book to him?
Thank you, Ananth. Before I start, if I can just thank you and Dr. Banerjee and Professor Swaroop for firstly this opportunity as well as the kind introductions. My gratitude to my school teacher who passed away very recently is for a simple reason. He used to teach us languages, social sciences, sort of, the software of your personality, so to speak. And of course, I consider that very, very important. But I think if I had to say, if I had to pin it down to one issue, it was that, I used to be in a Gujarati school called Fellowship School near August Kranti Maidan, Nana Chowk in Mumbai. And it was a very nice school, very balanced culturally and otherwise. But we had not had someone come in the state merit list at the 10th grade, the SSC exam, as they call it. And some of the teachers, and him in particular, they kind of took this challenge that, we can do it. We have to train the kids in the right way, prepare them so that they can break in, and we can have the name of our school in that list. I think I was just fortunate to be in one of the batches when they took up this challenge, and he particularly mentored me specifically, I think, for that target. He gave me coaching, private coaching actually, during 8th, 9th and 10th grade. And it's priceless in many ways, but priceless because he didn't charge my parents a single rupee actually for providing this, because it was partly also his challenge along the way. And what has stayed with me from that experience is that, you have to set ambitious targets, and then it takes a lot of toil, burning oil at midnight, persistence, failing, achieving again, failing, achieving again, but keep moving up towards those targets. And if I was to use, since I like music, if I was to use lyrics of one of the Hrithik Roshan songs, ki Lakshya ko har hal mein pana hai, that single-minded focus that one develops. And I think that to me was super important as a life skill, something to keep with you in life. If I could just give one more example here, and I've been thinking very hard about this role of teachers and the role of coaches. I like to play tennis, and when I see Roger Federer, Rafa Nadal, or Djokovic, or Serena Williams, or Naomi Osaka, all these are all, some of the best players in the world. Clearly, they have something that others don't have, and yet they all have coaches. They need someone to tell them what they are doing right, what they are not doing right, how they can be better. Yes, you have the potential, but how can you package it all together so that we can actually make it to the targets, get over the finish line, so to speak. And I think he played that role. He was very matter of fact with me at times about what I was doing right, what I was not doing right. And so it's always been there. In fact, if I may just add, I have this proverb. Actually, these are 2 lines that I had written myself in school in Gujarati, which translate to, I'm just a little matchstick, but I've lit all the lamps, and I call it Diwali. And I think that's how I always thought of him. He lit so many lamps through his teaching in our school. And I think he made us believe that, yes, we are not there yet, but we can break in. And I think that's why I've dedicated the book.
Thanks, Viral. That's very touching. And you use that proverb in your book as well. And I'm glad that finds a mention there. Tell us something about Pratham, Viral. I understand you're dedicating the proceeds of all this, whatever you get from this book, towards Pratham, which is absolutely fantastic. But tell us more about your work.
Yeah, I think it's a continuation of that theme. As I told you, and I think Dr. Banerjee touched upon this as well, which is that, giving someone education is, in my view, the best thing you can do to that person. My association with Pratham was a bit of a chance. I was doing anything but my dissertation work around the third year of my PhD, which is not that atypical for PhD students. So we had formed a band of students. We were singing Bollywood songs. We had connected with a professional band that would give the accompaniment and so on. And, we were rehearsing and we said, when you are young, you think anything you do is going to be a success. And so we said, okay, we will launch this band, and we rented the auditorium at Columbia University. But we said, who's going to buy the tickets? We are nobodies in the New York City as far as singing film songs go. So our band was called Surbar. We were trying to sell tickets, and one of our friends put us in touch with the founder of Pratham, co-founder of Pratham, Dr. Madhav Chauhan. And he said, why don't you do the concert for a noble cause, and people will actually come even to listen to the likes of you. To be in the auditorium if the proceeds of the tickets are going for a good cause. So that's how we connected. And then I had always felt that, what I got as a child, this priceless education, access to high quality teachers. And, it's not so much the material. I think it's that spark, as I said, it's just being lit, to fly, to shine, to investigate, learn, spread knowledge, and do something useful with your time. I said if that could go to so many other millions of Indian children, that would be terrific. So I naturally gravitated towards the cause. I've been associated with helping raise funds for Pratham in the US and then in UK. Right now in the midst of COVID, actually, Pratham has been doing truly excellent work. They had a lot of digital content that had been developed in a lot of Indian languages, and they have been delivering it through all electronic media, right from, iPads, laptops, all the way to the seemingly outdated technologies such as radios, because there are parts of India where you can't provide digital content through iPads, laptops, and even smartphones. We are at the lowest end of technology. But they have reached out. They're working with 14 state governments, 250 NGOs all over the country to actually deliver this content. It is reinventing itself digitally to that, if we can't start schools in time, if another pandemic stays or there are second waves, then how do we ensure that these children are learning and in electronic schools all the time? So I think, donating my share of proceeds is the least I could do, but I feel very passionate about the cause, and I think they are doing extremely valuable work, very low cost, scalable, replicable work all across the country, very problem solving, analytical approach. Many of you may be aware that their programs have been subjected to randomized control trials by MIT Poverty Action Lab, through the research of Professor Abhijit Banerjee and Esther Duflo, last year's Nobel Prize winners. They've actually done impact studies on how Pratham's education efforts are altering attendance in schools, learning outcomes, etc. And so I think it's fascinating work. I think this is really India's future beyond sort of any other issues that we will discuss very soon. Great,
Viral, thanks for that. This is the last simple nets quality question. After this, we go to the center court and we throw you some bouncers. This is straight from my student, and I'm going to try and read it the way he sent it across to me. Tell us your switch from being a gold medalist IIT Bombay computer science student to economics. Are geniuses as confused as the rest of us?
Yeah, I was actually very confused. I think that's exactly the right term. A part of this sort of my luxury of being in the merit lists and all that was that I had sort of evolved into a little bit of a nerd, I think, by the time I finished college and 12th grade. And I never really asked myself, what my inner calling is. What is it that I want to do with myself? I did well in the IIT entrance exam, and like everyone else, I just went into computer science. That was the theme of the time. But I think by the time I was about to graduate, I felt I didn't have that strong an aptitude for the field. I was trying to do very complex combinatorial mathematics, and I felt I'm hardworking, but maybe this subject is not aligning with my intuition, with my faculties, as well as one might hope. And so I took a course in IIT Bombay as an elective in my last year with Professor Pushpa Trivedi, who I consider really as my real mentor for getting me onto a different path. She taught a course in international finance. I didn't understand it that deeply, but I thought the subject was very fascinating. It seemed like economics, which is really about management of a household's expenses and wealth. That's what literally it means. I thought this is something I can touch more really than sort of, the trying to place graphs on a plane as I was trying to do in my BTech dissertation. And so I knew some family friends who had done a PhD in finance. One of them was at NYU, and I wrote to them and they said, this is an interesting field. It can be very analytical if you want. It can be very applied if you want. You can go to industry after a PhD, or you can go to academia. So why don't you give it a shot? And I think it was really, I just took a dive. I just followed my instinct saying I need to do something different because I need to figure out what excites me and pursue that rather than, to leave computer science at that time. A lot of people told me you're making a big mistake. It was such an exciting field, and I think it has been the most exciting field, but I just think I wasn't cut out for it. I had to follow my inner calling and passion, and I think I'm glad I made the switch. I think economics, finance comes a lot more naturally to me. Of course, I think I could be better, but I think it was the right switch to make. This is something I would like to just stress. That there is a lot of value in exploration in life. I think one has to keep retooling, reinventing oneself all the time. Sometimes it means taking new courses, entering new areas, trying to do something different. I find roughly every 5-6 years, I get a bit bored because I'm in a comfort zone of what I can do and I can do well. And I just feel it's not good to be in a comfort zone. You need to be struggling on the court. You need to be playing with someone who is hitting balls that you can't put back. Because if you don't do that, you will not get to the next step. You will not improve and self-actuate any further beyond that. So I think a bit of my foray into wanting to do policy, central banking was, of course, it was a natural step for the research I had done, but it is also a little bit to challenge yourself and learn something new. And as Dr. Banerjee said, it is, I'm sure in its own ways, it's going to affect my research very significantly over the next 5-10 years.
Thanks, Viral. That's a good answer. We'll go to the main body now of questions relating to the book itself. I hope you have your helmet on because I've got some doozies here. So the first one really is, by the way, excellent foreword from Dr. Reddy, your introductory chapter, as well as the epilogue. Excellent. Your speeches, market people like me have anyway know pretty much by heart. In the introduction chapter, you speak of, privatization of public sector banks. You indicate that was something that looked like happening at some stage, then it never really worked out. Why is it that you prefer privatization of public sector banks? It's a very controversial topic in India. So why is it? And we've seen a lot of governance issues in private banks as well. So why privatization? Why that theme?
Yeah, I think it's a great question. It's something that I have spent a lot of time thinking about. And ultimately, I think what is not appreciated in India is that privatization, nationalization, so what is not appreciated in India as much is the economic history of these banks. All these banks were private banks, barring one. And they were privatized they were nationalized in order to achieve a very specific objective, was that the center did not have foot soldiers to deliver its programs nationally. By nationalizing these banks, a specific government at that time basically got access not just to the deposits, as Dr. Reddy points out in the book, but also these branch officers and managers all over the country to start delivering national programs. Now, look at the irony of these outcomes over a 50-year period of time. How was it sold? By the way, this was a decision that Reserve Bank of India of the time had opposed, but it was overruled, and the nationalization went ahead. Look at the irony. The irony is that these banks were nationalized to provide last mile credit. They were nationalized to provide financial inclusion and serve the development goals of the country. And over the last 2 decades, what has been ailing these banks? What has been ailing these banks are large loans to large industrial firms. Okay, so I think this is a massively failed experiment in my view. And I think we need to be honest about it with ourselves, that this was something that's a historical accident. It was achieved for political objectives. It may have had an economic benefit in the form of financial inclusion and development, but we are far short of that. We are at 50 to 60% of credit to GDP in the country because these banks have become universal banks, and they are not just focused on what everyone keeps saying is the reason to have them in the system. So I think let's just be very earnest with ourselves as to what they were, why they were nationalized, why we keep saying that we need these banks, and whether they are ultimately delivering. I think if you do a simple calculation, if you had invested a rupee in these banks, say after global financial crisis, for example, and instead invested this rupee in the Nifty index or in the index of even private sector banks, I think the public exchequer has lost something to the tune, in my calculations, around 2.5 to 3.5 trillion rupees on how you actually do this calculation. These are not small sums of money. These are very large sums of money that could be available for true development and necessary expenditures, especially in a time like COVID. So I think reprivatization has to be on the table, because I think it's a 50 years of failed experiment in my view. I'll tell you something very personal. I know someone whose father worked at one of the large public sector banks. And he said he observed his father and whatever was going on at this public sector bank all through his life. And he said that his conclusion was that primarily these public sector banks, his assessment was that besides serving the interests of the government, they are primarily serving the interests of the labor. These have now become sort of cozy enterprises in which you have a lot of labor, and it's ultimately not clear what the objective is. It's very confused, because on the one hand, they are publicly listed, they're public shareholders, but government has large stakes, and there is an overbearing influence of the government in variety of their regulations and various kinds of lending programs and so on. So, but in the present scenario that India finds itself in, and by the way, this was the scenario even in 2017, in my very first talk in February 2017, and then in April 2017, I have 2 pages on what I had recommended. How will we deal with the losses that banks have to recognize when we restructure the failed loans, failed legacy loans? Of course, banks will take a capital hit. And one of the suggestions I had was that to reduce the burden of the exchequer, we should consider divesting beyond majority stakes and reprivatizing some of these banks. I think in the present scenario, if this is done, it will free up capital, it will reduce the borrowing needs of the government and allow it to undertake the necessary expenditures for relief and repair of the economy in the post-COVID era.
Thanks, Viral. One of the challenges to that line of thinking and that perspective is that we've seen egregious governance issues in private sector banks as well. Yes, there are good private sector banks. There are also those that have equally high, in fact, higher amount of NPAs and governance issues. Will privatization therefore really solve that particular problem?
See, it's not meant to be a silver bullet for fixing all of the governance problems. There will be failures of governance in the private sector. They are not just happening in Indian banking sector. They have happened globally as well. But let me turn the question slightly around, which is, we have governance failures even in our private non-bank corporations. I'm not talking about financial sector, in the non-financial sector. Does this mean we nationalize the country? Does we mean we nationalize every single corporation that's out there? I think we have accepted that the nationalized version of the economy is probably not capable of delivering anything beyond the Hindu growth rate of 3%, and worse, it may get punctuated by crises of the sort that we witnessed in 1990s. So I think there will be failures. We have to find ways to get over them. We have to try and minimize these failures to the extent possible. I think the central bank and the other governance mechanisms, Securities Exchange Board, are working all the time to ensure that these governance failures don't take place. But I think to say that the private sector ownership is a bad model because we've had some failures is, I think, a wrong conclusion, because at least there is capacity in the regulatory bodies to arrest these problems. They can get rid of the management, they can replace management, they can replace ownership. But these important mechanisms of regulatory discipline are altogether missing in case of public sector banks, because the Banking Nationalization Act overrides certain powers that the central bank has and other regulators have. Second, the market discipline on these institutions is very weak, because more than majority of the stake is with the government, and essentially an investment in these entities is essentially an investment on the government support that's going to come down the line. So I think with market discipline and regulatory discipline both being substantially weakened, I don't see how you can run these enterprises well. I think ultimately we have to answer the question, what is the public taxpayer loss of investments in these companies delivering in the end? And to make it more constructive, I'm of the view that the healthier public sector banks, you can divest stakes, reprivatize them. The smaller and the weaker public sector banks, where this may not be possible because their return on assets, market to book ratios are just very, very small. I think what they need to do is really need to reprioritize them for what the development objectives are. We have developed these models of small finance banks, microfinance institutions. Why can't public sector banks, some of the smaller ones, regional ones, why can't they be transformed into performing exactly the justification we keep giving for their existence? Why is there no talk of that? And that really begs the question of whether they are out there for an economic reason, or are they out there because they are serving some other political objectives of each successive government out there since 50 years, as I said. Yeah.
No, thanks, Viral. Great perspective. I'm going to switch tracks to a completely different topic now. And I'm going to refer to your October 26, 2018 speech, a memorable speech in many ways, where you warned of the wrath of markets, amongst other things. It's been a funny time for markets vis-a-vis economics. We've seen this complete breakdown between fundamentals and markets. And by the way, this happened even before COVID-19 in the case of India. So even before COVID-19, we had fiscal excesses which were fudged or not reported. We had a governor leaving us. We had a deputy governor leaving us. We had growth slowing down, lots of things happening. And yet markets, whether they were currency markets or equity markets or bond markets, were largely behaved. Have markets become the dog that does not bark anymore? Do we need to fundamentally rethink this point about markets being a control on excessive behavior by market participants?
That's a great question, Ananth. It's in a way very deep. It gets right at the roots of, whether increasing role being played by governments and central banks in the economies is really the way to go forward, even though that has become the norm since the global financial crisis. I think it is good to reflect upon the debate that was going on between John Maynard Keynes and Friedrich Hayek. Right after the Great Depression, Keynes was always pushing for automatic stabilizers, fiscal stimulus, monetary stimulus as a way of helping the economies in Great Depression come out of the liquidity trap. Hayek and the other Austrian economists were warning that I think, I'm not saying it in exactly their words, but my interpretation was that they were concerned about economies moving towards becoming more centrally planned economies as we did that. And they were worried that a step in that direction could potentially bring capitalist economies closer to socialist or communist economies in the central planning sense. They were worried that this could lead to loss of enterprise. So, one of Hayek's book is called The Road to Serfdom. That when you make an economy very centrally planned, it kills the entrepreneurial, innovative engine inside the hearts of the people. And I think this is the deeper question we have to ask. I think about my speech at the cost of, erring on the side of trying to glorify it. But I think to give it the right academic context, I think of the Eddie Schroff Memorial Lecture as basically saying this, which is that you need a balance between regulators, markets, and the governments in how an economy functions. There is a role for each one. I think this is also the central thesis in Raghuram Rajan's recent book, The Third Pillar, where he says, the community, the grassroots are actually getting neglected in how the markets, the central banks, and the governments are coming together in trying to fix the economies. Coming back to your more immediate question about what sense do we make of the markets, I think the markets are where they are because the central bank puts have now become very, very large. Look at the size of the systemically important central banks. They are 4, 5, 6 times larger than what they were before the global financial crisis. They have not been unwound, and we have kind of in the COVID phase, we have rightly or wrongly, clearly, temporarily, the accommodation might be necessary, but we have sort of gone back to the same step. People are asking in the United States whether the support provided for junk bonds, for example, is that really necessary? Is this really turning a capitalist economy into one where all losses are always socialized and so on? I think my research raises one important question about these policies is that when central banks have accommodated through their balance sheets and interest rates, both the government excesses as well as the private sector excesses. So they've provided a floor, soft landing, but they have done so without restoring financial stability. That they have done so without recapitalizing banks, without recapitalizing shadow banks, that the growth gains are not there to be seen. I keep referring to the examples of Japan in 90s and Europe in the last decade. Here, the central banks have gone down the path of accommodating and preventing markets from unleashing their wrath. I think if I could say the markets did unleash their wrath, that's why they undertook the balance sheet expansions that they did. Maybe less so in case of Japan, more so in case of Europe. But the growth and the productivity are not there to be seen. And I think this is the key theme of my book, that financial sector stability is the key ingredient for temporary accommodation measures to help and produce the longer term outcomes. If you simply keep accommodating as a central bank through extraordinary measures, and by the way, I don't even call it financial stability. That's not financial stability. That's financial relief. That's not long-term repair of the financial sector. To keep accommodating the financial sector through asset quality norm relaxations, through lower interest rates, through surplus of liquidity, that's just relief. Long-term financial stability, it's about its own strength. Does it have private insurance? Does it have private capital buffers that can absorb losses and therefore allow market-based economies to function without continuing interventions of regulators and the central governments. My thesis is that I'm asking for evidence from anyone who claims that a centralized model of the government and the central bank combined has actually succeeded in delivering thriving growth. I think it may be a fine model of preventing financial crises because you are always there to mop up. But it doesn't lead to high productivity, it doesn't lead to high growth. And therefore, I think financial stability to me is the unstated prerequisite for some of the extraordinary actions that get taken to deliver the long-term gains.
That's a great answer, Viral. So to summarize, what you're saying is there is a wrath of markets, which is implicit. Therefore, you have extreme responses from the government and from the central bank to prevent that meltdown from happening. So you do prevent a meltdown that can be stopped, but that's at the cost of long-term growth and what you could have achieved otherwise in terms of long-term quality of your economy, I guess. Segue to the next question. If at the moment inflation is under control globally, let's keep India aside for the time being, some of the excesses that you would have seen in markets are not visible because of exactly the pumping which has happened. This is almost heretical theory of modern monetary theory doing the rounds, which is that if there is no inflation, if things are okay, print some more, don't be too orthodox in the way in which you've thought about fiscal balance, etc. Your own thoughts around this and its applicability or otherwise in the emerging market and Indian context.
Right. No, I think this is, of course, the theme, the theme of the global finance and economics right now. I just want to clarify that, in my view, it's not a theory. No internally self-consistent model of modern monetary theory, or MMT, has been written down. This is a hypothesis. It relies on some extraordinary assumptions, in my view. Let me just highlight two of them. First is that it assumes that government expenditures have significant fiscal multipliers. And I think this is not true. This is simply not true even in developed economies. I think it's very clear that when governments create public goods, when they create infrastructure, education, health, etc., kind of benefits to the economy, they have significant fiscal multipliers. When they just keep doing subsidy-based transfers, not only are the fiscal multipliers low, they are very often below 1, suggesting that you are not even getting one-for-one benefit on the medium-term to long-term GDP. So I think this idea that somehow all the resources of the economy in one way or the other need to be channeled to the governments and there is no limit on their borrowings is, I think, firstly reliant on the assumption that the government, it goes back to this Keynes versus Hayekian debate. I think Keynes was not saying that governments need to be large all the time. He was saying governments need to provide the automatic stabilizer when you are coming out of a liquidity trap or a very distressed situation like the Great Depression. He was not even talking about ordinary recessions. He was talking about the Great Depression. The second fantastic assumption of the MMT is that whenever you ask them, oh, if you create so much money supply and as and when the growth activities pick up, if they pick up in the first place, if they do pick up and inflation rises, how will you stop this monetization? And they say, oh, yeah, at that time, someone has to stop the valve. And my question is, how will you know when to stop the valve if there is no market? If the market, through its wrath, is not going to give you incipient signals of changes in investor expectations, of either long-term inflation expectations having become unanchored or long-term debt sustainability concerns now being raised in the markets, if you don't get those signals, are the central banks going to figure these things out on their own? Most likely they will be late. Just look at our balance of payments crisis of the early 90s. We had no signals. We were more or less a nationalized economy, what Dr. Reddy calls the government financing, public sector banks, and the central bank being a Hindu undivided family where no one kept anyone's accounts. Then you will get the wrath of the markets in a completely sudden stop sort of a manner. So my question to the MMT is that it works until it doesn't work. And unfortunately, there is no evidence that this level of stimulus without fixing financial stability has delivered. I think the only economies I have which stand out as when governments and central banks have joined forces to expand balance sheets largely, expand their expenditures largely, and yet deliver on growth and productivity. The best example is the United States. But all that the Federal Reserve did was not just to do quantitative easing. There was a TARP, there was a recapitalization of the banking sector, there was a Dodd-Frank Act, there were stress tests put in place to inject capital on an annual basis in the US banks, far in excess of the Basel capital requirements. And I think this is what is required for that machinery to work. Nevertheless, even if you put financial stability in place, I think MMT still has to answer the question of where will the signals on inflation and debt sustainability concerns come from of when the central bank is supposed to stop the monetization. I think there is no written down model that I know of that tells you how the central bank is supposed to respond to this. So it's a very attractive theory because it makes the short-term problems look very easy to solve. But I think it doesn't answer what you will do when the imbalances rise. In fact, I think India offers the best lesson for the MMT, in my view, from where we were in 70s, 80s, and what sort of a crisis we had at that point of time.
Thanks, Viral. I'm going to push my luck on one aspect. You talked about two conditions for MMT. The first one being that there is no fiscal multiplier because most of it goes into revenues expenditure rather than capital expenditure. If theoretically, if the government was to come out with a deep investment plan, let's say into education, healthcare, nutrition, followed by other things like roads and ports and so on and so forth, would that make a case for more monetization and larger fiscal deficits in that case?
I think there would certainly be a stronger case for them in my view, but let me answer this in the context of India as an example. Let's think about that scenario. Presumably the idea is not to nationalize the entire economy. You still want the private sector to function. So the idea of these expenditures is that it will crowd in also private sector growth and investments. Private sector also needs financing. Net in India, it is a dissaver. So it actually takes in more cash from somewhere than on its own. How will it do that? It will have to rely either on domestic savings or on foreign savings. The domestic savings in India net are smaller than the net dissaving that the government does. So on the margin, our private sector is actually reliant on external source of funds. We are not a hard currency, so we are not going to benefit from global shocks in terms of being a safe haven. So these investors are going to ask the question: do you have inflation credibility? Will the value of the money that I have put into your country get lost by the time I actually pull my dollars out? Because actually the currency has massively depreciated by the time I'm taking the money out. So I think the second question is as important, which is where is the inflation credibility in MMT and where will the signals come from? And if it is lost, or if the inflation concerns rise, do you have institutional arrangements in place? And this is basically what fiscal dominance is. I think this is the title of my first chapter in the book. Sargent and Wallace, who sort of created this concept of fiscal dominance, their idea was that if you don't have a central bank which has an independent legal mandate to maintain inflation stability as its primary concern, then when governments for short-term pressures, or even when they are justified short-term pressures, expand their balance sheets, they might confuse the central bank. Because if there is going to be a national catastrophe, if the government cannot roll over its debt, so you have a full-fledged sovereign crisis, then the central bank will be forced to focus on that objective and set aside its focus on long-term inflation. And this dominance needs to be broken by preserving the institutional autonomy of the central bank in sort of almost at the cost of sort of, making it blinkered in its vision, so to speak. And this is what I keep telling everyone. I always get this question: don't you think inflation targeting has growth consequences? Of course it does. because you are taking some short-term growth pain to commit not to lose sight of this objective in the long run. That's how an inflation targeting central bank builds its credibility, that for small output gaps, it will actually not always accommodate, because it needs to actually build credibility that it is going to remain focused on inflation in the long term. I think this is going to become a theme not in India. I think this is a theme right now, even in developed countries, where the central bank balance sheets are becoming so large and so much is being asked of them to be done, that even former central bank governors such as Mervyn King are asking the question, are central banks doing too much? And will they go down the slippery slope of the fiscal pressures dominating the central banks and their regulatory policies, even in the developed economies?
Thanks, Viral. I'm going to come to this point that you're making about the need for policy rules over discretion as far as central banking is concerned. And the second, the independence and autonomy of institutions such as the RBI. On the second part, or the central point you make is we've got to give space to the central bank, let it be independent and autonomous. My question is there enough accountability for central banking actions? There have been mistakes by central banks as well. Supervision mistakes in the case of India, the PNB scam, PMC, and so on and so forth. Likewise, even in conduct of policy, inflation estimates have gone completely awry on both directions, overestimation as well as underestimation. Now, is there enough accountability on the RBI? And if there is, how do we get the confidence that we can let this institution be as it is, and self-correct for its mistakes going forward? How do we ensure that accountability?
Right. Yeah, that's a very good question, Ananth. No easy answers, but I've tried to offer a few suggestions in the introductory chapter in the book. Personally, from whatever I have seen in research, I value democratic accountability of the central bank a lot. I think the central bank should be asked to provide reasons for both its ordinary time and extraordinary time actions. I would prefer if this is done in the form of well-articulated and detailed reports which say what are the intended consequences and the likely unintended consequences of its actions. Are there sunset clauses on certain policies, or are these just meant to be near permanent fixes, etc.? But if I could just take a global example here, it is regarded that Federal Reserve represents many of the best practices, if not all, in central banking. And yet this is a central bank that did have its failures spectacularly in the lead up to the global financial crisis in supervision, perhaps even in the interest rate policy, as many would contend, even though there's no definitive agreement on this. Professor Julio Rotemberg, an academic in sort of, the central banking and economic history, he wrote this very interesting article on the 100 years of Federal Reserve. There was a NBER, National Bureau of Economic Research conference, and his thesis was that the history of reform and reinvention of the Federal Reserve is essentially one of retribution. That it makes mistakes, bad things happen, and then the central bank tries to figure out, okay, how do I ensure that this doesn't happen again? Of course, over long stretches, imbalances develop, and then again there are failures, but then the central bank tries to do it all over again. I think this is exactly what has happened, in my view, in case of Federal Reserve. Look at the changes it has undertaken in asset quality norms, capital requirements, stress tests. These are very, very significant changes compared to what we had in the pre-global financial crisis era. Why? Because the central bank, maybe not in public words, but it has acknowledged that we made mistakes and we have to avoid these from happening again. I think this is what long-term institutions do with the right people. They always are self-critical in getting to the right point, because there is no sort of public assessment. These are technocrats. They are not sort of elected officials, and so their assessments are internal and through self-criticism. I think in case of India, the question that the book is raising, perhaps Dr. Patel's book is raising even more explicitly, is why is it that in spite of the recognition that we had this excess, when steps were undertaken to actually put in place the foundations or the pillars of financial stability for the next decade, 2 or 3 decades, that we had a reversal. And my answer or thesis in the introductory chapter is because our fiscal dominance, the fiscal dominance of the Indian central bank's regulatory policies, the state of our fiscal stretch is far in excess of what it is in many other countries, especially in developed countries. We don't have the fiscal space for doing a lot of what the government wants to do. And the natural pressures then come on almost all actions of the central bank. And I think I would say the one action that has not been affected as much is the monetary policy, in my view, the interest rate setting process. And that is because here we did put in place an institution of monetary policy committee, a flexible inflation targeting framework, a very explicit mandate, democratic accountability for each member of the monetary policy committee by requiring that their minutes state why they voted the way they did. I think we need more institutions of this type because they will exonerate the central bank at times from yielding to the pressures that are coming from the authorities, and at the same time allow it very naturally to say no, as has been said in the case of interest rate setting process.
Okay, follow up to that, Viral. Does RBI acknowledge mistakes enough? I've not seen a single policy statement which says we was wrong. I've not seen any mea culpa of any kind, whether inflation estimates I mentioned to you, supervision issues which came up, for instance.
I think, as I said, finish.
I was saying the points you make in your chapter about democratic accountability, which is having papers, etc. Do we do enough of show and tell? And are we really honest about some of these reviews? Maybe that will help credibility a lot more and give you the independence or give RBI the independence it seeks.
So my experience was that what the central bank has tried to do is pretty much along the lines of what I was describing as the Federal Reserve's experience of learning from past mistakes, having this sort of internal sense of retribution, wanting to reinvent, reform, improve all the time. And if I could say so, why did the efforts to clean up the bank legacy problems start? Why were they taken as much forward as they were allowed to go on? Why did we put in place an inflation targeting framework after the taper tantrum? Because the sense was that we needed to build credibility of inflation outcomes and not be seen as a fiscally dominated central bank all the time as far as inflation outcomes were concerned. So I think my sense is the central bank acknowledges its mistakes more through its corrective actions. It is this sort of cycle of mistakes that happen for whatever reason. I have a thesis that they happen in India partly because of this fiscal dominance. But even if they happen because of some other mistakes of the central bank on its own, I think the technocrats do look internally. They are self-critical. They try to put the central bank on a new path. When I was there, we tried to put a blueprint of what the supervisory cadre should look like. It is both to recognize the increasing demands on supervision given the increasing complexity of the financial sector, but also to recognize that we need market-based intelligence, we need stress tests, we need a risk management approach to be internalized by the supervisors themselves so that they are themselves asking the question, what will happen if this scenario was to materialize? At least that's my assessment. Of course, I think we could do more in terms of more justification through well-articulated reports. And I think that is true of many central banks around the world. If I could just make one sort of very specific point on inflation, because this comes up a lot. I thought quite a bit about this issue on the forecasts, and we should distinguish between two things, Ananth. A forecast of inflation at a given point of time, this is going to be a slightly technical answer, but I think it's important. The forecast of inflation at a given point of time is based on assumptions on the trajectories of a lot of market-based prices, such as, say, oil prices. It is based on outcomes of food prices. Now, let's take these two, because I think these are two very important components of Indian inflation. To expect that a central bank should get its oil price forecast right all the time is asking for too much. I think so. Those who keep saying that the central bank missed its forecast, they need to ask the question if the forecast was right under the assumptions on the oil price trajectory that were made at the time the forecast was provided. Now, if the forecast went wrong because the oil prices within a year went off to 85, I don't think that's a failure of the model that the central bank was adopting. It is because it is a map from the assumptions on the trajectory of oil prices to the inflation forecast. Let's take food prices. Do we know what exactly the policy of the government on minimum support prices is going to be ahead of time? Even if they announce the policy, will they always procure each year and maintain these prices? These are unknowns. So the central bank's models have to make assumptions on the trajectories of these food prices. Now, if you can give reasonable assessment that the assumed trajectory was outlandish relative to what the data has shown or what would be a reasonable set of assumptions to make, I think then it's a perfectly fair assessment and criticism of the inflation forecast. But I think when they just go wrong because the world is uncertain, I don't think that's a fair assessment. And if I could just make one last point here, therefore, I'm a big fan of stress tests. I'm a big fan of model risk. There are lots of uncertainties on government policy and external sector policies in an economy such as India. And those risks have to be factored in. So you have to do model averaging across a whole range of forecasts so that you don't end up on one side of the errors dramatically, at least not over a long period of time. I think crises happen fundamentally, Ananth, when imbalances are allowed to be built up over long periods of time. Crises don't happen with 1 year of error or 18 months or even 24 months of error. Crises happen with slightly longer term errors, and model averaging prevents you from being too much on one side over a long stretch of time.
Thanks, Viral, and that elaborate answer helps because Sridhar Shivaram on the chat gave a question along those lines, and you've just answered that question, I think. I'm not sure if Sridhar will be satisfied, but it's an answer anyway. On policy rules over discretion, I'm going to borrow a question which Dr. Subbarao mentioned in his speech yesterday at your book launch. This is on monetary policy framework. There is a sense, at least among some of us, that this is a bit of a dogma, that we don't have enough research to show whether policy interest rates can truly control inflation in India, as you said, which is 54% food and oil prices put together, right? So when we say that we should be bound to inflation targeting, interest rates 2 to 6% and so on and so forth, are we tying ourselves to dogmas and therefore can we really rely on that for giving autonomy to the institutions?
Right. So I would fully underscore Dr. Subbarao's plea for more research, more assessment of how the inflation targeting framework has played out, how the monetary policy transmission is happening. Is it happening in the right fashion to the right places and so on? There is actually a paper that was recently shared with me by Professor Chetan Ghate. I believe Poonam Gupta of the World Bank, Barry Eichengreen from University of Berkeley and co-authors, they have taken a completely independent objective assessment of the inflation targeting framework in India. In fact, Dr. Ghate told me that Poonam Gupta she said in one of her presentations that she was actually a skeptic of the framework herself. But their assessment of the framework based on observable outcomes is that actually this has worked reasonably well. If I could add another point, one of their primary thesis and then they test it and they provide support for, is that actually the central bank has been quite responsive to the output gaps. So this claim that inflation targeting is a dogma is partly on the basis that it has not factored in adequate growth considerations of its own. The assessment of these authors seems to suggest that that is not the case. The central bank has not been overly obsessed with just the target rate that has been set. It has allowed deviations, and these deviations seem to be in line with what they measure as the output gap considerations at different points of time. Now, Dr. Subbarao also raised another question that globally the inflation is close to zero, and in India it is much higher. I don't want to put words in his mouth, but I think it raised the question in my mind as to whether our inflation target is actually too high. It is 4%. It is almost full 4 percentage points higher than where the inflation is in many parts of the world. United States was the only country that sort of delivered close to 2% inflation in the developed economies over some period of time in the last few years. So, but I think I want to end on two points, which I think are very important in any assessment or review of inflation targeting that may get done on India. First, that inflation targeting was put in place in India because that is what builds credibility, that the central bank will not let inflation go for a toss when the fiscal and the growth pressures arise. This credibility has to be maintained with external investors. Our net international investment position is very large. And it's negative. So we are net guzzlers of foreign funds in order to support our growth. And so no assessment of inflation, what I'm trying to say is that inflation targeting framework cannot be narrowly assessed on inflation and growth outcomes. The external sector stability also has to be kept in mind. In my view, a part of the wrath of markets, in spite of some of the imbalances, has not been there, because the central bank has repeatedly sent the message, one, that we have an inflation targeting mandate and we are committed to it, and two, that our management of the external sector through reserves management, macroprudential capital controls is going to try and deal with external sector volatility of the exchange rate, but not necessarily to pin down any direction. And I think in combination, in my view, this is actually the right policy mix for India. The second point I want to stress is that some of the failures of the monetary policy transmission are deeply rooted in lack of adequate capitalization of our banks. Listen, the research all over the world shows convincingly that undercapitalized banks either don't lend, they are very risk averse, or they lend simply to evergreen the loans of their legacy borrowers. There is no evidence that when you recapitalize banks, when you get them to be in better shape, that is constraining of growth and productivity. If anything, the evidence is exactly the opposite. So the monetary policy was not transmitted in Europe when ECB took these extraordinary actions. Why? Because a part of the banking sector in the peripheral countries was weak, and they were not interested in making fresh loans. They were more interested in zombie lending, the way we saw it and the way Japan saw it in the 90s. So I think the inflation targeting framework itself will work better if we devote more resources to restoring financial stability, both in banks and non-banks in our economy.
Great. Thanks, Viral. I'm going to leave the last question to you, and then we'll take on audience questions. This is a look forward question. In fact, it has two parts to it. One is your field of expertise is banks and financial institutions. And you made the point in the last answer that recapitalization of banks is going to be extremely critical. But given that the state of banking and financial institutions in general right now, as we're going through COVID-19, is even worse than where you left it at, what is the way forward? So if you were to advise India, the powers that be, what would be the 3-4 things that you would do at this point in time? Why don't you answer that first? I'll go to the next part.
Yeah. So I've tried to work out a strategy in my mind. It turns out it is also the strategy I had put in the introductory chapter pre-COVID. I had finished writing the chapter before the COVID outbreak around me and in India. I have a two-pronged strategy. First and foremost, we need to recapitalize banks. I think RBI's FSR stress tests should be used to determine which bank and non-bank needs what level of capital. In case of private banks, many of them have already gone to the markets. The others can be required to go to the market to raise this. They need to raise capital, add capital to the balance sheet and preserve it. I see that former DG Vishwanathan has also actually made this point recently in his remarks. Stress tests, because I think we have to prepare for larger losses than what we think are average losses coming out of COVID. We are in a fog of uncertainty and we need to prepare for that. This will also raise the recap bill for the public sector banks. There are two ways to go. If you take it as given that the government has no capacity to add any more, then the bill has to be footed through market fundraising and asset sales. Both of these can be undertaken. I think government divestments can happen beyond the majority stake, as some of RBI's board members have also supported. But I'm in favor of putting reprivatization of some of the healthier banks on the table, along with a focusing of the business model of the relatively weaker public sector banks. And nevertheless, I think the government will need to undertake some necessary expenditures beyond even the recap of the banks for the economy. It has been suggested that infrastructure could be an area, and of course, so many people have been saying this for very long. So that's the second prong of the strategy that I'm recommending, that rather than going in a freeze mode, where the government says, oh, I'm concerned about a rating downgrade, I'm concerned about sending wrong signals about debt sustainability, and therefore I won't do the necessary transfers, etc. Instead, what the government should do is to create a medium-term fiscal plan which rebuilds the credibility. You know, rating agencies have explicitly said that it is the lack of adherence to the FRBM targets in the past years which gives us lack of confidence that if you slip now, you will rein the deficit and debt to GDP ratios back in time. So what's a way out? I have 5 points. I'll say them very, very quickly, Ananth. One, improve the transparency and earnest accounting of the fiscal numbers. No longer above the line, below the line, inside the balance sheet, outside the balance sheet, before 31st Jan, after 31st Jan. Let's just tell ourselves where we are so that we know what is the gap from where we need to be. Second, reaffirm adherence to the FRBM targets, even though we are in the midst of COVID over the medium term. 3-year, 5-year targets need to be put in place. Third, setting targets is not enough if you don't have an institutional mechanism to adhere to it. What is that institutional mechanism? It can be an independent bipartisan fiscal council that monitors the expenditures and holds a mirror to the government. Listen, this is your scorecard. This is where you are headed, and we can't approve any further expenditures, unfortunately. The budgets, as the 14th Finance Commission chaired by Dr. Reddy had recommended, budgets should first be approved by the Independent Fiscal Council. Are you making fantastic growth assumptions to say that you're going to stick to targets? If those growth assumptions are not reasonable, the budget needs to be fixed before it is announced. So that's number 3, Independent Fiscal Council. Fourth, I would say that disinvestments need to be put squarely on the table, not just in the financial sector, but even otherwise. This can't just be cosmetic disinvestments of just, one arm of a PSU buying another arm, or a PSU floating debt to pay a dividend to the government. That doesn't change public sector borrowing requirement or true consolidated government deficit position anyway. So I would say that has to be on the table as the number 4th point as well. And finally, I would say that the government needs to recognize that the debt markets need to function at the same time that the deficit financing, maybe if done in a short-term measure by the central bank, happens, because we do need markets to give us the right signals so that we know when we are erring on the side of too much. And so I would say a balance between the role of the markets and the central bank in the financing of the government would be a better way to go, rather than leaning the pendulum too much completely in one direction.
Great. Thanks a lot, Viral. What I'm going to do is take some questions from the audience. And if we have time, I'll come back to a few follow-up questions that I have on the 5 steps that you mentioned.
Sure.
First, we have.
I'll try and keep my answers crisp. I know I'm sort
Fine,
of
fine.
I'm going a bit too long in some.
I have no constraints. The constraint is yours. So as long as you can stay on, you can stay
Okay. Yes, yes.
The Sriram Mahadevan has this question. What is your assessment about RBI's surveillance tools and quality as you took over and when you demitted office, and perhaps now? We've seen some loud and large failures in finance and banking. What are your thoughts around this?
I think in the continuing the theme I was mentioning, I think the central bank is constantly trying to reinvent and reform, be self-critical, and learn from sort of every lapse or mistake that occurs. I think one direction, besides the supervisory cadre that is proposed to being created to have greater specialization in the supervisory team. And I hope that is allowed to be taken to its natural completion inside the central bank. What needs to be done is that a lot more data analytics need to be put on the table. Stress testing methodologies could be brought in line with the best global practices. I think the Financial Stability Unit, in my view, does do a very, very thorough and careful job. Even though some view that it has been short of the projections they would have liked, I think it has been, in many cases, prescient about the upcoming problems. So I think the stress testing methodology could be given a more central role in supervision as well as regulation. I would like the supervisors to use stress test outcomes as a possible signal for knowing where to actually delve in more. And I would also like to be a greater input into regulation as to how much to ask banks for capital. Don't just rely on Basel capital requirements, in my view. In some cases, we have to rely on stress tests because we have other kinds of relief measures that are always in place. And you want to be ahead of the game because it's only well-capitalized banks with excess buffers. Like, let's take COVID shock. If we had excess buffers, we can absorb the losses and yet provide intermediation in the recovery phase. So I think those are some of the directions in which RBI could go more: specialization of human capital, more data analytics, and use of stress tests in both supervision and the regulatory functions.
I think that's a very honest answer, Viral. Thanks for that. I have a very dirty question from S. Chandani, which I'm going to pass on to you, which is, what is your view on the independence of the RBI? Is the central bank in India independent?
I would encourage you to see Dr. Reddy's forward. He explicitly says that in the letter of the law, the RBI, what the RBI Act enshrines the RBI with, that RBI is one of the weakest, least independent central banks in the world. But of course, de facto and de jure may be different. And he then goes on to say that for a while, though, the independence was easy to defend because you had this sort of Hindu undivided family arrangement between the government, public sector banks, and the central bank. Over discussions with other former governors and deputy governors, I seem to have found one explanation for why I think these pressures are now sort of simmering more. I think it is because we have moved from being a nationalized economy to a market economy. This Hindu undivided family arrangement isn't what the economy is about anymore. There are markets. Private sectors are borrowing, private sector firms are borrowing, both domestically and internationally. And one other development that has happened is that India's savings rates were very high and constantly rising. But over the last 10 years, there is a trend that perhaps because of the credit-fueled consumption stimulus, the savings have started coming down. And this creates further pressure if at the same time the fiscal is overstretching in parallel. So for a while, we were consolidating, the growth was high, and we were consolidating government deficits, growth was high, and the savings were also rising at the same time. So it was sort of like a Goldilocks scenario for an economy trying to transition from a nationalized economy to a more private economy. I think things are now reversing, unfortunately, on all of these dimensions. Growth is slowing. the fiscal is becoming overstretched rather than consolidating, and the household savings rates are coming down. And I think this begs for some very fundamental questions about how we can turn the tide back to the Goldilocks scenario that we had.
Thanks a lot, Viral.
But this is creating pressures in the same arrangement that we had before, because the government needs to borrow, reduce its bills in one way or the other, and everyone wants to turn to the central bank to accommodate whatever policies it can, so that in one way or the other. My reason for giving 5-6 examples of fiscal dominance was not to give sort of very micro details, but it was really to show that the pressures can be very pervasive and across board.
Oh, great. Thanks a lot. I have a question from Nishant Rungta, which I'm going to pass on to you. This is to do with the discussion paper from the RBI on governance in banks, in particular in private sector banks, capping of tenure of management, etc. I don't know if you've had the chance to go through that, Viral. And in fact, we also had former Deputy Governor, Mr. Vishwanathan, talk about it. But do you have any thoughts about this governance paper at all?
I must confess, I have not studied it in great detail. So probably former DG Vishwanathan would be the best person to answer questions. I would say that in my assessment, too much of a concentration of public ownership in the stakes can lead to outcomes which are not that different from the outcomes we have seen with public sector banks, which is, on the one hand, if you have a very good owner manager who has a concentrated stake in the bank, you can get a very good outcome. On the other hand, that can also mean bestowing too much power on one person who can then influence board appointments, internal processes, governance committees, audit committees, and so on. So without having seen the paper, all that I would say is that Reserve Bank of India's push over a period of time for getting the large promoter stakes to be brought down to manageable levels, I think is in the interest of overall governance of the system, even though you could take an individual bank and say, oh, why wouldn't you give this owner a large stake? But you have to work on average outcomes. You can't just say that because one bank is going to have the right rule, I have to ignore the errors and excesses in misgovernance that have happened elsewhere.
Great. I'm going to combine a couple of questions from Gopal Tripathi and Prashant Jain. Are central banks expanding the balance sheet to an extent where fiat currencies are in danger of losing credibility?
I'm in the camp of this sort of economists who like to think that money should be maintained as a sound form of medium. It should neither be too much in excess, it should not be too much in deficit, and that when it becomes too much in excess, and of course, currently it's being done because pandemic has induced a very large contraction and growth shocks. As I said in my response to MMT, the question will be, how are you going to deal with this deluge when the growth recovers? If the inflation impulses are there, or if fiscal dominance impulses are there, will the central banks then resist the calls of the sirens and stay tied to the mast at that point? Listen, look at last 10 years. Federal Reserve could not really complete the normalization of its balance sheet even over a 10-year period. So, we have to wait and see. I think one of the things I've recommended in the book is that extraordinary steps taken by central banks can possibly be announced with sunset clauses. I think this will almost be a way of allowing yourself some discretion to, when your rules are not right, to go back to your sort of favorite debate, Ananth, which is that when rules are not right, you do want discretion. But I think sunset clauses give you a way of not making extraordinary actions your only ordinary policy, which is, that extraordinary actions are being done all the time. Then you just will be fighting fires because you are giving such a large put option to the markets that they are always betting on you coming and stepping in all the time. So.
Great. There are a couple of questions which have come to me privately. So I presume the people asking these questions don't want their name to be announced. One question is, would you like to come back to India and work here?
Yeah, it's always on the table. Of course, it's a very personal decision at the end of the day. I was away from my family for 2.5 years. I used to do this crazy 12. I once did a 12-hour trip to New York to watch my son act in his school play. I landed in the morning at 7 a.m. The show was at 2 p.m. and I took the 5 p.m. cab to the airport and came back. So I need to regroup and reunite with them as I've been doing since last August. But if the right opportunity comes, India will always be, and it's always inside my heart. And I would like to give back. I still think I have something to give back. I also think I have some proofs left inside me. So I do want to continue doing the research as well. But we'll see how it goes. I think I can still make some contributions from outside, hopefully.
Great. There is a market participant who has again sent me a private message and a typical market question. Mulla ki daud masjid tak. If you were in the MPC, what would you do next week for the policy? What would your prognosis for the policy be?
So, it's a tough question because I'm no longer as up to date on all the inflation models and forecasts. And, of course, the data has also been not that easy over the last 6 months. Some prints were not there in the first place. Some forecasts were provided by RBI, but some others were not. Separating it between core and non-core components may also be a challenge at the present point of time. So, I wish MPC all the best. My sense is that inflation is higher than what most people had thought. I had my concerns last February, April, June as to whether it was likely to be as benign as everyone was claiming it to be. I thought the food inflation had really hit a low and it was likely to rebound rather than actually continue on its path as people were assuming. I don't want to claim victory or anything, but I think it highlights this point a little bit of model averaging. I just felt that simply erring on the belief that we have killed food inflation and its momentum is going to be very low was basically taking on too much model risk in my view. I think you have a legal mandate. In my view, I think what the MPC should take seriously is that you have a legal mandate. You are charged with maintaining a headline target rate of 4% on consumer price inflation. Yes, there is a caveat which says you have to pay attention to growth, but there's a reason why it's the secondary objective and not the primary objective. So in my view, you can put different weights, but you can't alter the primacy of the legal mandate that is given to you. You have to respect that. That's what democratic accountability is about, in my view. So.
Great. There are a bunch of questions which I'm going to combine. There's one from Prashant Jain, which says the RBI's financial stability report talks about under extreme stress, the NPA is going up to 14.7% of advances. What is your assessment of banking NPAs? Related to that, there are questions from various people asking how bad is it, how bad do you think the state of the Indian economy is, and particularly the banking system. Do you really expect financial stability risks to come up here at this point?
We calculate this NYU-Stern systemic risk rankings where we use market-based stress test data. So we try to project if there was like another big market correction to the global economy, then how much market equity will different Indian banks lose and how much capital may have to be injected to restore them to, say, 8% market equity relative to non-equity liabilities. That does seem to suggest that there has been an increase in this number through, on something on the order of, I get numbers which are on the order of $10 to $20 billion of capital, which is not small. Of course, that's a very stringent stress test. It's also in terms of market data. But I think RBI stress test at a minimum should be taken as a serious acceptance that the stress could be high. Of course, Professor Ananth Narayan himself has some estimates of what the losses might be. So do some other analysts. And I think rather than worrying about what the numbers may be, I think it would be better, in my view, to use the time constructively to shore up the capital of the financial sector balance sheets on almost a war footing. I would use the next 2 months or say 3 months to work with the government on divestments of stakes, asset sales in public sector banks, get private banks and small private banks which have not yet tapped the markets, get them to tap the markets ASAP. Perhaps do a quick asset quality review of the NBFCs, at least the relatively large NBFCs, and get them used on a stress test kind of approach, which the FSR must have done to some extent. Again, get them to raise the capital. And where the capital is not adequate, figure out what to do very quickly. I think we should not waste time while I know that some discussions are taking place on restructuring, which basically means asset quality, recognition, relief at the end of the day, etc. I think all that is tried and tested. It doesn't work other than as a temporary stopgap measure. If you want economy to recover well, you need a thriving financial sector. And I think the answer to that is capital, capital, capital.
Great. Viral, I'm conscious of time. It's 10:30 Eastern Standard Time, 8 p.m. India time. We're supposed to have stopped now. Are you okay to extend by 5-10 minutes?
Absolutely. I'm totally available. So.
Thank you so much. Really appreciate this. This is a question close to my heart, and you've heard me talk about this ad nauseum. This is from Mohit Mayank. Sir, what are your views on creating an independent bad bank to tackle the NPA, now that the FSR is suggesting there'll be a significant increase in NPAs?
It was something that I had favored before I came to the central bank. I think I had given an interview with Bloomberg Quint in maybe just a month before my interview with the appointments committee for the RBI position. And I think when the stock of legacy problems is large, there is something attractive about sort of doing the cleanup decisively once and for all, rather than, it being done in a lot of sequential steps, especially when, the pressures and the regulatory landscape are changing so quickly as in India. Once I went to the central bank, I gave it a more nuanced version. In my February 2017 speech, I recommended creating a private asset management corporation for assets which were not related to infra, power, etc. And for assets where you could say there are some public good aspects, I asked for creation of a national asset management company, because it could be that the full value of some of these assets may be greater to the government as a whole, which internalizes the public benefits. I think if done right, these would be still good ways to undertake. I think the key is that we need to do a cleanup. I think that is what is key. If you are able to achieve it through swift resolution through the IBC, very good. If you are able to do it through out-of-court restructuring, very good. If you need to set up these asset management vehicles, you can call them I think maybe asset management vehicles sounds good. A bad bank doesn't sound as good. Doesn't matter what you call it, but if that is the way you want to achieve it, very good. But I think ultimately the one concern I have is that when these corporations get set up, who will run them? What will their mandate be? And will they get off the ground in a relatively quick manner? We do set up institutions through the government, but very often they may take 18 months or 24 months to get going. And I think if that is what happens with a bad bank or a national asset management vehicle, of course, that's no different than assets just lying in limbo on bank balance sheets. So I think the key is to do a cleanup. There are many options. They can all be fine if they deliver the ultimate objective of dealing with the legacy problem resolution and recapitalizing the banks and NBFCs as a result of the resolution of these assets.
Okay, a question from Ashok Bhundia, which is, are there structural reasons why the banking system is grappling with such high NPAs? Can something be done to improve corporate governance in India in the short run?
in spite of what we have observed, I'm still of the view that the deeper problem, the deeper malaise of the banking sector is related to fiscal dominance. It is related to the fact that government pressures to relax bank regulation, to relax other measures, to get public sectors to do what the governments want are just too high in the present context. And first and foremost, we need a departure from that. How do we do that? A better fiscal condition would help on the government balance sheet, because then they'll be more willing to recap the public sector banks, and then the pressure to relax the rules is not as high. Or government can get out of the banks in certain cases, get out of the publicly owned financial institutions and insurance, etc. in some cases. And others, they could really prioritize them in their business objectives very, very sharply, so that we know what they are supposed to do and we can hold them accountable for delivering on those objectives. There is always scope for governance improvements. I think that is true in abroad. I think that's true in India as well. And I think, even though I have not studied the RBI report, clearly the fact that RBI has come out with a report on this suggests that this is an important issue for the central bank to be thinking about.
Great. Thanks a lot, Viral. In the interest of time, I'm going to stop here. I'm going to ask the last question, which actually comes here, as well as was a question which came up yesterday. Yesterday, Dr. Subbarao spoke of, we analysts like me tend to restate the problem rather than actually offering solutions. Now, one solution, which in fact Sajid also mentioned, is that effectively we need high growth to come up eventually for us to be able to pay for whatever we are building up in terms of fiscal excesses right now. Do you think India's long-term potential growth has come down now? And what do you think that number is? And second is, what do you think we ought to be doing now to achieve that growth potential?
So, I don't have a specific number in mind because I haven't redone the potential output calculations. Just to give a slightly technical first part of the answer, typically, no one comes and there's no oracle that tells you how the potential output of the economy is changing at a given point of time. So economists have to rely on estimates from data. And very often when you see a sustained trend or several data prints that repeatedly show that the growth outcomes are low or the growth outcomes are high, then there will be a more significant revision in the potential output estimate. So if you have a stretch of low numbers, a Bayesian econometrician who's updating and learning all the time from data will say that, I have to now put some weight on the fact that perhaps the potential output is low. Similarly, if you get a string of good numbers, you will revise your potential output on the higher number. So that's one way to go. I think these estimates can be redone. And I think having some knowledge of how these models work, I think India's potential output has got to be revised downwards based on our most recent prints, in my view. But second, there is a structural way of thinking about this. And I keep going back to the core point of the book, which is that potential output of India cannot be taken as something that's independent of the health of its financial sector. I think financial stability is an unstated prerequisite for government policies, for central bank policies, and for private sector policies in the sense of governance, etc., to deliver. Because at the end of the day, while we are trying to develop our bond markets, we are still primarily a bank intermediated economy as far as credit markets go. And if the efficient allocation of credit to the right, healthy, and the most productive users of this capital doesn't happen, we cannot achieve our potential growth. And so I think this is a thought, maybe is a good thought to leave with all of you as we end, which is that financial stability, the health of the financial sector balance sheets should almost be considered, in my view, as a structural reform, because it alters the potential output of the economy, in my view.
Great. Thanks a lot, Viral. I know I've skipped a few questions. Most of them, I think, have been addressed in the comments from Viral. In case there are questions which you think have not been answered, do send them across to me through SPJIMR, and I will try and get an answer from Viral. Viral, there are lots of students here on the call as well. any words of wisdom to the youth and to the students of India?
Oh, my trajectory was so confused, as I was saying at the beginning, that I don't know if I'm the right person to really give any words of wisdom. I think my only, maybe if I could boil it down to three sort of short points. First, I would say, get your foundations right. I think it's very important to learn basic micro, macro statistics, econometrics very right. Don't be in a rush to start understanding very complex things. That will become a facility, once you know how to understand the basic questions. That's one. Second, I would say read a lot, and including not just classic books, but also read things like The Economist, read the newspaper, read articles that are coming out by others, because you have to try and marry the frameworks you are learning in your courses with how they help you understand what's going on in the world. Very often there are gaps, and very often in trying to answer those gaps is when the maximum learning actually takes place, because then you have to start from first principles. Why is it that the book is saying one thing, but what's happening in markets or in the financial sector or in the economy is opposite of that? That's second. And third, I think I would say keep asking questions. I think it's more important to raise important questions than always to find the right answers, because research, etc., is a very long-term process. You reach understanding only through collective efforts of different people. But very often, I think the most influential scientists and researchers have not been the ones who have always provided the right answers, but they have raised the right questions. And so keep your scientific curiosity alive at all times, retool, reinvent, and just follow your passion. I think follow what is your internal calling. I think that's the most important thing.
I couldn't have put it better, Viral. That was brilliant. So Viral, quick closing words from me. I have to admit, I'm a fan. To me, gold medalist, computer science, BTech, IIT Bombay is the closest to God I'll see. And I start with that bias, unfortunately. Second, I do disagree with some of the arguments you make, but very few of them. I think by and large, I've learned a lot and I continue to learn. What you do display is what Dr. Ranjan Banerjee mentioned earlier, which is courage and heart, which is frankly required in abundant quantity at this point in time. You mentioned, in fact, in your book that initially you face a lot of adulation, and thereafter there were also tough times. To stick through those times and stick to your principles, that requires courage of conviction and a very, very big heart. So thank you for that. I think you've made a big contribution towards the debate in India. And hopefully, as you end your epilogue with, we will get to our immense economic potential as well. So that's the next big thing. And finally, something else which is close to the heart for SPJIMR particularly, which is you've influenced practice and you're extremely socially responsible. So here's to a long second innings as well. We are hoping to see you back in some form or shape again in India. But thank you. And it's been a tough week for you. You've had a lot of media interactions over the last 1 week. I think you've been bombarded by several bouncers, by notable people. And I was adding to that list as well in my own dirty way. So, but thank you for being here and thank you for taking all these questions. If there are residual questions, I will bring them across to you at your leisure. If you can take a look at them, that would be great.
Sure. And if I could just make one thing, I think I don't want anyone to walk away with the image that Ananth has given. I think I'm just a very ordinary person with a very ordinary mind. I work hard and I don't give up my wicket easily like Rahul Dravid. I think that's the only thing I'm capable of doing. So thank you so much for the opportunity, Ananth, and I hope to receive the questions. I'll try and respond to them over email if I can very soon.
Great. Thanks a lot, Viral. Really appreciate and all the best. Have a great weekend.
Yeah, all the best to all of you and your families. Thank you.